Adani Enterprises to raise rupees 20,000 crore in India's largest ever FPO. Should you invest or stay away? Gautam Adani has become a household name in India over the last decade or so. In the past year alone, the Indian industrialist overtook the likes of Bill Gates and Mukesh Ambani to become the third richest person in the world and the richest in India. The business tycoon's meteoric rise has also helped the Wall Street investors earn blockbuster profits. For instance, Adani Group's flagship company, Adani Enterprises Limited, AEL, has nearly doubled investors' wealth in a year. In the last 5 years, the share price of the company has rallied by a staggering 1,760%. Now, AEL is planning to raise rupees 20,000 crore through what would be India's largest follow-on public offer, FPO. So, what is an FPO? For the uninitiated, an FPO is like a relaunch of a listed company share for the public. When a company wants a fresh infusion of funds via new investors after an IPO, it launches an FPO. In doing so, it dilutes the existing stakes of its promoters and other existing shareholders. In this case, the 72.63% stake held by AEL promoters will reportedly be reduced by 3.5%. The move will ensure that around 30% of AEL stock will be held by the public. FPOs are a rare occurrence in the Indian stock market. In fact, there have been only 4 FPOs in the last 10 years, as against 250 QIPs, qualified institutional placements, and 150 rights issues. QIPs and rights issues are the alternatives available to already listed companies for raising capital. A case in point, Reliance Industries raised around rupees 53,000 crore in a rights issue back in 2020. However, only existing shareholders get to participate in a rights issue, unlike FPOs that allow everybody to get a piece of the action. FPOs are generally considered to be the safer bets than IPOs. This is because in case of FPOs, investors are already aware of the company's past performance in the stock markets, which is not the case with IPOs. As we have seen recently, many startup IPOs in India were listed at inflated prices and tanked, causing much pain to retail investors. Moreover, FPOs are offered at a discounted price. So why is AEL offering an FPO? From airports, solar cells and defense technology to mining, data centers, edible oils and desalination projects, AEL has a finger in almost every pie. It is also a debt-ridden company. Now, AEL aspires to use a major chunk of FPO funds, that is rupees 10,869 crore, to fund its green hydrogen and airport management projects as well as greenfield expressways. In addition, almost rupees 4,165 crore will be utilized to repay the borrowings of 3 of its units: Adani Airport Holdings Limited, Adani Road Transport Limited and Mundra Solar Limited. AEL's financials don't offer a rosy picture. As pointed out by almost all market experts, AEL is a company in heavy debt. The pro-AEL lobby might reason that this is the fate of all infrastructure-based companies, which are capital-intensive in nature. Adani backers also highlight the company's ability to raise debt, which speaks volumes about the trust people have in its core businesses. To do some number crunching, AEL's net debt increased from rupees 14,240 crore in FY21 to rupees 37,107 crore in FY22, even as the revenue grew nearly 75% in the same period. So in a high debt company like AEL, the return on capital employed (ROCE) becomes a crucial ratio for determining profitability. Here we see that the ROCE has declined significantly from 5.6% in FY21 to 4% in FY22. ROCE is a measure of how well a company is using its capital for generating wealth for its stakeholders. Issue of new shares via an FPO can further decrease a company's earnings per share (EPS) as the number of outstanding shares increases. A dilution of EPS can cause a fall in AEL's share price as the company is often valued based on its EPS. Even after a steady increase in total assets year on year, AEL has witnessed its profit after tax (PAT) decline from Rs 1045 crore to Rs 787.7 crore between FY21 and 22, chiefly due to increasing debt. So, what to bear in mind before investing? AEL's FPO will be launched on January 27 and close on January 31. The listing date is set for February 8. The company's FPO price is expected to be in the range of Rs 3,112 to Rs 3,276 per share. Retailers can also avail themselves of an additional Rs 64 discount per share. A portion of 35% of the offer is reserved for retail investors who have to bid for a minimum of 4 shares and in multiples of 4 subsequently. The idea of picking up a stock at a discount in the FPO draws many investors. But as attractive as this sounds, the shares can also fall below the price at which they were initially allotted. Precisely, this scenario played out after Yes Bank's FPO hit the market in 2020. The floor price of shares was set at 50% below the prevailing share price at that time. However, Adani's focus on renewable or green energy is a big positive and can trigger the next boom in the Indian economy.